So we'll start first with a brief, very brief overview on what's been happening in the market last year, based on our market statistics, and then we'll move to a panel to talk about the GP-led market and what's been happening and what's the outlook, and then that will be followed by another panel on the LP-led market, and equally exciting and coming back from the dead, so to speak, throughout last year. So perhaps a few brief words on our firm, Greenhill. So Greenhill is a boutique investment bank, 15 offices, about 400 professionals. There are 3 business lines, M&A, financing and structuring, and then our team, which is private capital advisory. And we do both primary fundraising, and my colleague Andrew, who will moderate the GP-led panel, can tell you a little bit more about that. And then obviously we are one of the main players in the secondary market. We have a very long track record, having started originally as Cogent Partners back in 2002, and have an extensive track record both on the LP side and on the GP-led side. Brief overview of our team: about 30 professionals split between the US, Europe, and Asia. Now, big question. So what happened to the market in terms of volume? We received feedback from, I would say, the majority of the 100+ buyers we surveyed. So these numbers are not yet final, but quasi-final. So I think the volume for 2022 will be somewhere between $100 and $110 billion globally, and that's across both GP-led, LP-led transactions, but also the different asset classes, so buyout, venture growth, infrastructure, real estate, and private debt. And I think what we saw is that the market started pretty strong in the first half of last year. We had a significant increase from the year before, and then we had a bit of a slowdown in the second half. I think that was also a period in on the macro front with a lot of uncertainty, rising interest rates, increasing talk about a recession in Europe, in the US, and then we also saw obviously public markets being pretty volatile, and that certainly had an impact on activity. I think a big factor in the reduction of activity, both on the LP-led side and on the GP-led side, was certainly the increasing gap between private market and public market valuations. And I think I'll show another chart in a couple of minutes, but essentially, public markets came down about 15 to 20% last year. Then they rebounded, obviously, more recently, while private markets valuations have not moved at all, so to speak, overall. So that gap is essentially then reflected also in the discounts, and has certainly also contributed to, I would say, a greater selectivity, and also, I would say, risk, averseness from buyers. So I think in terms of the mix between LP-led and GP-led, I think the majority of the volume was on the LP side, so it was probably around, I would say, probably around 60%, and then the GP-led side was probably somewhere 35 to 40. We'll have exact numbers next week when we publish our global secondary market review, but just to give you a bit of a sense. I think if you look at it, in the historical context, despite the drop from 2021, which was a bit artificially boosted by the fact that a lot of deals were, pushed from 2020 into 2021, I think in the historical context is still a very strong number. I think you can see that 2019 were 88 billion, so I think still a very healthy development. Now we need some acceleration to get to the, I think, the trillion dollars in volume predicted by certain people in the market. So I think we're all very optimistic, but give it a bit of time. Now pricing, as I mentioned, I mean there has been this gap between private markets and public market valuations. Generally, I think pricing, has dropped and is more or less at a 10-year low overall. So overall pricing, that's the violet line here, dropped from 91% in 2021 to 81%, so at about just less than 20% discount. We saw that buyout came down also from close to par to about 84%, so about 15% discount. Private credit, which is the pink line, is at about 17% discount. And then I think the one strategy which has fared the best is infrastructure. And I think the fact that most of the assets are inflation protected certainly played a role. We've also seen a significant amount of buyers raising dedicated funds for secondaries in infrastructure, and I think all of this capital coming online has also played a role in supporting pricing. But overall, we've seen this type of assets price really well. And then the strategy which has taken the biggest hit certainly been venture and growth, where the average high bid was at 68%, so a little bit more than 30% discount, which is not surprising. If you see what happened to Nasdaq companies, some of them actually down 50%. And so I think it's just a reflection of a lot of uncertainty. I mean, we've certainly also seen a decline in volume in terms of venture and growth supply. The sentiment was very much that neither the sellers nor the buyers were really sure whether we had reached the trough in terms of valuations. And I think there is a bit of a wait-and-see attitude. I mean, it will be interesting to see what happens to Q4 22 valuations and whether GPs in the venture and growth space actually mark the assets to market or not. If they mark them to market, I expect this discount to be reduced as we go into the next couple of quarters, but let's see. So overall, I would say we see discounts, but the market is working, and we've seen very good level of buy-side interest, though it's been very selective, and we see a lot of, for example, LP portfolios being sold as mosaics rather than to a single buyer. Now, last slide to just illustrate this, the gap between public and private valuations. The line in blue is the Lincoln Private Market Index. So that's an index, I think, which covers about 3,600 sponsor-owned buyout companies, mostly in the US. And you can see that throughout, the end of 21 and 22, essentially the index even went up a little bit, whereas the S&P 500, which really started to correct at the beginning of, towards the end of the first quarter, and dropped quite significantly. So I think that explains a lot why we are seeing discounts, and I think as GPs maybe become a little bit more realistic around valuations, then these discounts will come down again. But I think indications from discussions with LPs and GPs is that unlikely that much will happen in Q4. So I think maybe it will take a little bit longer, but let's